Morning, everyone. My name is James Fox. I'm a Director in Indirect Tax in EY. I'm also a committee member of the Cork Society of Chartered Accountants Ireland. I'm very pleased to welcome you all here this morning to this exciting webinar that we have on raising finance for your business. We're delighted to welcome three speakers this morning. Fran Stafford from Bank of Ireland Corporate Banking, Susan Law from Business Banking in AIB, and Ciara Fitzpatrick from the Investment Services Division in Enterprise Ireland. Fran, Susan and Ciara will talk through various matters this morning which would be of interest to your business. And first up is Fran. Fran is a Senior Manager on Bank of Ireland's Corporate Banking team in Munster. With 14 years experience as a finance professional, Fran has worked with businesses, investors and advisors across a variety of sectors and transaction structures. In her current business role, Fran works with new-to-bank business customers to develop and deliver tailored banking solutions to meet their funding and day-to-day banking requirements. Fran qualified as a Chartered Accountant in 2017. Fran qualified as a Chartered Accountant in 2017 and holds a Bachelor of Science in Business Information Systems from UCC and a Master's in Corporate Strategy and People Management from NUIG. Please feel free to leave any questions at the bottom of your screen in the Q&A and we'll pick them up later in the morning. And now I'll hand over to Fran to commence.
Thanks, James. Good morning, everyone, and thanks for joining us this morning. To kick off our Raising Finance for Your Business event, I'm going to give an overview of bank finance, I suppose specifically focusing on a cash flow lending perspective. It's certainly an interesting time in the Irish banking market at present. I think regardless, there are core fundamentals that continue to apply in terms of raising finance from a bank. So I'm sure for a lot of you, they may be relevant in terms of either raising finance for your business or indeed advising your clients on raising finance for their companies in turn and their financial strategy. So I'll just run through quickly the presentation I'm going to give today. So firstly, I'll talk through preparing a finance request and just information and preparation for that. Then I'll run through the credit assessment process from a banking point of view. So what are the things the bank looks at and looks for in that sort of request? Secondly, we look at considering a finance offer or proposal when you receive it, things to consider and look out for to make sure you get the best, I suppose, structure and form of finance for your company. And then finally, we'll run through some examples of finance Bank of Ireland has provided in the Munster region. So before we jump straight into preparing a funding request, I've outlined here some key factors just to consider when you are proposing to go and raise finance. And these are really, I suppose, key in terms of the strategic plan or growth objective of your business. And ultimately, that feeds into your financial strategy for your business. So things to think about here, what are we raising the finance for? Why is the investment needed? Is it to fund growth, be it organic or acquisitive growth? Is it for a balance sheet event, so either to recapitalise or release equity to shareholders? So the short, medium and long-term outlook here also important. Again, that feeds into your financial strategy. So what does the company need in terms of its finance requirements in the short term? And then when you look at longer term, what are the appropriate financial supports that you need to put in place or need to work towards getting in place to support your longer term strategy? Risk then, obviously, in terms of your business risk and financial risk, consider them in the round. So financial risk obviously brings in, a prior call on your cash flows and other elements like interest rate fluctuations to your business. And finally, then just shareholders, there should be a discussion at board level around the capital structure that's going to be put in place in the business and the impact that introducing debt can have on that. So things like what cash do we want to retain on balance sheet? How much cash do we want to use versus how much debt we may look to take on? And then just considering collateral that may need to be provided in raising finance and, the comfort level around that and any preferences there. So I'll take the next slide. Thanks, Fiona. So preparing a funding request then, obviously good financial MI is key here. It's a real foundation stone for, I suppose, raising finance. And I suppose regardless of whether, your MI system is top of the range in terms of sophistication or, is at the other end in terms of, a less sophisticated Excel-based system, there are fundamentals that are really important. So, having a robust, thorough, detailed set of financial information is really important. Numbers that you can, I suppose, stand over, give detail behind, and give credence to your strategy as well, in terms of where you're going to take the business and how you're going to take it there. The bank will also need to understand your company's ownership and governance structure. So they'll want to understand, who are the key management personnel, and what are the governance procedures and structures that are in place. So a purpose and payback then of any finance is also key. So important to think about, again, what is the purpose of our finance? What are we going to use it to invest in? What's the rationale for that and the business case? And then the payback period. It's generally something that you will negotiate or agree with your banking provider, but important to think about any factors that may need to be considered in there. For example, there may be a ramp-up period for a new investment where the payback period may need to be delayed, or an interest-only period may be appropriate just to accommodate the cash flows of the business. Security that's available then is obviously another aspect to be considered raising finance. So have a think about what assets are available as collateral on the company's balance sheet. These don't always have to mean that you have a property or a building available. So I've listed some other examples there to think about. Stock, debtor books, assignment of key contracts, share security are all, I suppose, different types of security that we look at across different financing structures. And I've just noted there, another thing to think about here is any existing debt or security arrangements that may be in place. Always good to note these up front, just so they can be accommodated or noted in terms of any overall security arrangements. Once, I guess, we've pulled together the information for a funding request, we might just talk through what are the key things the bank will look at and focuses on assessing when it receives in this formal request. So as I said, we're talking about cash flow lending here as distinct from property investment or development. So the key here in a cash flow lend is cash available for debt service. That is what the bank, I suppose, focuses on in assessing any finance proposal for such a business. Repayment capacity is really the foundation here. So the focus is on establishing cash available for debt service. And how do we do that? We look at establishing the maintainable EBITDA of the business. And this looks at taking into account historic performance as well as current trading, and then looking at the future projected performance of the business. So it tries to get, I suppose, a really understanding of the underlying earnings potential in the business. And this can take a lot of analysis and interaction between a bank and a borrower to really, I suppose, strip out any one-off impacts or events and get behind reported numbers to understand what are the key drivers here. And again, understand what is the core earnings within the business. This EBITDA figure then is adjusted for obligatory cash outflows that the business needs to fund annually. So tax, working capital, capital expenditure. When we talk about capital expenditure here, we're really talking about a normalised or kind of maintenance level of capital expenditure, as distinct from more one-off projects or larger expansion investments. So that kind of normal level of capex that a business needs to maintain year on year, to maintain its assets, to maintain margins and operating standards. And then just noted there any other outflows. So where there may be directors' loans that are committed to a repayment schedule. Sometimes you might see if there's other leasing or financial arrangements in place there that need to be accommodated within the cash flows. So ultimately, you want to get to the final figure here, which is what cash is left over to fund your debt service. And this then is used, I suppose, to establish the quantum or the leverage level that is comfortable for the business to take on. So leverage is your ratio of debt to EBITDA. So I'll move on to the next slide there, Fiona. Thank you. So there are other factors, I suppose, that go into and are considered when you're looking at the quantum in particular, or the leverage level for a business. So the cash available for debt service, once established, will then be stressed for certain variables that will impact that. So fluctuation in interest rates is obviously a factor. So taking into account the interest rate environment over the horizon or the term of the loan, we'll want to stress test on the impact of those fluctuations. And we'll also look at, I suppose, variance in financial performance. And the key here is to make sure that, I guess, there is a level of headroom built into any finance structure. So, you know, there will be bumps along the road as we go through any economic cycle. And it's important that, you know, a business isn't overstretched in terms of the debt service it needs to manage. So that's the purpose behind, this was a lot of the stress testing that we would do when we look at these proposals. In general, I suppose a higher level of certainty in any business or predictability within a business will facilitate raising a higher amount of finance. And some of the areas that feed into that will be the underlying business model in place. So looking at the business itself, what are the revenue drivers there? So depending on the type of business it is, if there's more certainty, which is driven by longer term contracts, long-term stable customer relationships, strong brands, or intellectual property, anything that really protects a company's competitive position. These are all factors that we would take into account in terms of looking at the strength and predictability when we look in particular out at projections for any company. Again, I mentioned key costs and fluctuations there. So we look at then from your revenue, what are the factors that influence the margin that you derive from that revenue? So, and how can they vary and how can they impact and change from year to year? So again, that ties back to the competitive position, the certainty around revenues, and the supply chain, anything that it goes into your cost line there. What kind of certainty is around that? What controls do you have? And then sector characteristics also, I suppose, in a wider picture feed in. So depending on the sector you operate in, you know, is it particularly prone to cyclicality? Are there factors that influence the cash flows in particular? So some sectors may be particularly capex intensive, and therefore year on year you have a much heavier I suppose cash flow commitment in terms of reinvesting in your capex continuously. I've mentioned there some other factors finally. So foreign exchange risk will obviously impact your cash flows, in interest rate or hedging risk, inflation, COVID-19 and the impact of Brexit are obviously the more recent factors that we've all had to consider, have impacted, you know, a lot of the finance requirements we've looked at, particularly over the last 12 months. I know Susan in the next presentation is going to go into a lot of detail on dealing with those factors, particularly in the context of raising finance. So there obviously have been a big focus in recent times. So we'll move on to when you're considering a financing proposal. So when you've gotten through, you've got your funding proposal submitted, the bank has run an assessment process, and if you've received an offer of funding, how do you, I suppose, assess that offer, weigh it up against, again, your financial strategy, you know, your strategic objective of the company? You want to make sure the finance you're raising is suitable for your business, and that, I suppose, really the terms and conditions that are attached to that are key in terms of, are they right for my business going forward? So important here, I guess, the devil is in the detail when it comes to looking through any finance offer or term sheet that you receive. So I've listed out some of the key items here. Quantum is obviously key. Have you gotten the amount that you need, or you're looking for? Again, consider the mix of facilities there. So whether your requirement was for a term loan or whether you had a working capital requirement, is the right mix in there? Certainty of funding then. So obviously consider committed versus uncommitted facilities. Committed facilities mean a capital cost for the bank, and therefore will mean a cost to have those facilities in place for any borrower, versus uncommitted, where you've less certainty around the availability of the facility, but you don't have an ongoing cost to carry. So again, it's important to match that to your business requirements. Cost then of any facility is made up of different components. So margin, fees, and then I suppose importantly there at the end I mentioned legal costs. So important to understand from any finance proposal what will this cost to document and to implement in my business. So whether there's security to be taken, always good to get a good understanding of what this will cost from the outset in full, and to incorporate all those elements into assessing that. Financial covenants then, just the next slide please, Fiona. Financial covenants are important to consider in any proposal. So what covenants am I signing up to? Am I comfortable I can meet them? You know, am I happy that even basic things like timing periods for delivering accounts are comfortable and meet, you know, are realistic in terms of what I can deliver? The flexibility you might need. So are there any additions or changes that I would like to see in my proposal that maybe the business would like to extend their facility longer and would like to have the option to make an early repayment, ensure there's no penalty clauses built in. So these are all things that we would, you know, see customers come and talk to us about and say, look, you know, there's something in here I would like to maybe talk to you about negotiating or changing because it's a requirement of my business, or it would suit my requirements. I'm thinking 2 or 3 years ahead. So finally there, I've just touched on experience and execution capacity. So, you know, don't look at any finance proposal, I would say, in isolation. Look at, you know, who's the party you're dealing with here. Do they have the capacity, you know, to deliver? Have the track record, previous experience? Are you happy with who you're dealing with here? And it's somebody that you want to establish a long-term relationship with. So finally, we might just go through some examples of the types of finance proposals that Bank of Ireland has looked at in Munster. These are over the last kind of 12 to 18 months. So I've put a range in here of the different, I suppose, types of structures that we've looked at and the different types of finance that companies have been looking for. I've listed 2 larger kind of corporate banking transactions, and they're the most recent ones there. So you'll see one of those was an acquisition, and that was, I suppose, a comprehensive package of facilities we provided to both finance the acquisition transaction as well as provide working capital facilities in the form of invoice discounting and overdrafts to support the business. We've also seen a lot of requests for growth finance. So where a company may have some existing debt and then is looking to refinance that and put some growth capital on top. One of the more interesting ones there was a refinance and equity release transaction. So we have seen a lot of companies talking about equity release in the context of succession planning and shareholder reorganisation in their business. We have seen that come to the fore a little bit more in the market over the last 12 months. Some of the other examples there, as I mentioned, growth capital is very much coming to the fore now in a lot of the finance proposals we're looking at. So overall, we're seeing maybe a lot of refinance activity in general in the market. And we hope to see a lot more, I suppose, activity going forward. So I'm conscious of time. I'm going to wrap up there, James. Hopefully I haven't run over too much. So thank you.
Thanks very much, Fran. That was really interesting. A lot of thought provokers there. So thanks very much for that presentation. Next up, we've got Susan Law. Susan is Senior Relationship Manager in Business Banking in Cork and AIB. Susan has worked across several financial institutions for over 20 years and has extensive experience in new money lending, debt restructure, credit analysis, and leading high performance teams. She's managed a wide variety of clients across property investment, property development, professional services, trading SMEs, and corporates. So Susan, over to you.
Thanks, James. Good morning, everybody. It's really lovely to be here this morning, and thanks to Fiona Collins and to Chartered Accountants Cork for the opportunity to speak today. And thanks, Fran, for that really interesting presentation. So I'm going to go through what happens when the bank receives a funding proposal, particularly the new challenges we face in 2021, considerations in applying for funding, availability of SBCI funding, and other alternative sources of support. I know most of you are already very familiar with this process, whether you're in industry or representing clients. So the bank receives the proposal, incorporating all of the areas that Fran has mentioned, and assesses it ultimately in terms of ability to repay the loan and the robustness of those repayments in times of financial stress. But just on the next slide, on top of this usual assessment, however, there are new issues that we must consider for 2021, including the short-term impact of COVID lockdowns, the likely longer-term impact of a move to remote working and towards the online provision of service, and of course, Brexit. I'm aware that there are varying levels of experience in the room this morning on this, and I know everyone will be very familiar with the financial aspects of raising funding for your business. But what I've tried to do in this presentation is to incorporate all the questions we're getting at the moment from bank clients and to address the most common issues and gaps we're seeing in funding proposals. So starting with COVID on slide 19. As we closed out a very busy and very unusual 2020, we had hoped for a different and more positive start to 2021. However, the reality is we are still working against the backdrop of a rapidly evolving challenge of COVID and further periods of increased restrictions. And while there is light at the end of the tunnel in terms of vaccine rollout, the reality is that the impact of this will be felt in Irish businesses for the majority of this year and for certain sectors well into 2022 and beyond. So in submitting a funding request at the moment, it's really important to consider the following points. It can be very hard to prepare projections for a company or a client in a rapidly changing environment like we are in, but there are really good sector-specific views available now on likely recovery for the different sectors. So for example, the different banks will have an internal house view from their sector-specific teams. Industry representative bodies provide forecasts and guidance and so on. So for example, say you're looking at a hotel. Let's take a resort-based leisure or family hotel in Cork or Kerry or Limerick. It's reasonable to assume, based on the information at our disposal, that there will be strong domestic demand in H2 of 2021, with international visitors returning from mid-2022 onwards. However, that same information is showing us that it's likely to take maybe 2 to 4 years for city centre hotels and hotels that have relied heavily on corporate travel and international conferences to recover. So the impact of all of this needs to be assessed and realistic assumptions made. You need to consider whether the business can change its mix of offerings in anticipation of altered demand. If there are restrictions for the rest of 2021 in terms of numbers at events, or if demands for large conferences or large-scale business travel is affected for the next, say, 2 to 3 years, what can be done instead? What considerations can be given to alternative use of space? It may be that nothing can be done, but it's really important to show that consideration has been given to all of this in looking for funding. With regard to your base year, it's also really important to have a view on what the last normal sustainable year for the company was. For many industries, 2019 was a really good year based on several years of organic growth. And 2020 started really positively, better than 2019 in fact. So it's probably reasonable to assume that unless there are exceptional factors, 2019 was a decent base year. So what's your base year? Show us what it's going to take you to get back to your base year. What are your projections? Do they match the industry view? Are they overly ambitious or too pessimistic? And it's very important to strike the right balance here in being realistic. It's also really important to include what actions have been taken by the business to date. What discretionary costs have been cut? Has the business considered its mix of offerings in anticipation of changed demand? Has outdoor space been utilised? What safety provisions are in place for customers and so on? And lastly, are there opportunities for the business? Is there likely to be pent-up demand for a service offering upon reopening? Is there an opportunity now to renegotiate leases? What staff retention measures are in place? Are staff being trained in anticipation of it? What's the time to reopening? And while there are unlikely to be any snap decisions about sectors reopening, it's really important to know how long it will take to open the doors and that the business is ready to do it as soon as it can. All of which will be considered by the bank in terms of assessing if the business is viable long-term and or is likely to need a period of longer-term support. So just moving on to slide 20 there. This just shows a small sample of some key COVID-related considerations by industry that we'd expect to be addressed this year in any funding proposal. So say hotels, we've spoken about hotels. Where is the hotel? Who are the customers? Is it golf and leisure? Is it city centre? Does it rely on summer concert business or weddings, for example? Is there a heavy reliance on large conference business? What's the mix of domestic or international tourists? What plans are in place to attract domestic travel this year? Then say restaurants and gastropubs. Is there outdoor space available? Has it been utilised? Is there any issue with the retention of staff and chefs in particular? What safety reassurance measures are in place? And it's interesting to note that there is a view emerging that this may be a feature beyond COVID, as customers may remain protective of safety and their personal space. Say non-food retail. Where is the shop located? What's the product offering? Is it heavily reliant on 9-to-5 office workers? So for example, if you had a city centre store specialising in, say, the sale of men's suits or men's clothes, it's reasonable to assume that demand will remain low in 2021 due to a shift to working from home, smaller weddings, smaller funerals. It's questionable whether grads, formal events, black tie dinners, and all that will go ahead. So can the product offering be enhanced or changed? Fishing. So while the sector as a whole has been heavily impacted by COVID, there is a difference in the subsectors. For example, the pelagic sector has held up really well, but exporters of white fish have been most challenged. COVID appears to have had less impact on the farming sector than on other SMEs, with average 2020 farm incomes rising by 6% and increased margins reported across the majority of farm sectors. And then bars are likely to be among the last sector to fully reopen. Pubs with outdoor space are likely to be advantaged, and pubs in tourist areas favoured by international tourists are likely to be the slowest to recover. So that slide is just there to pick a few sample industries and just to show the types of questions that we'll ask when assessing a funding proposal at the moment. So just moving on to the next slide there on Brexit. Look, I know everyone in this call is fully aware of Brexit and Brexit readiness. The point I just want to make is, despite being overshadowed by COVID, it really hasn't gone away. And there's some evidence emerging that while businesses stockpiled in anticipation of December 31st, that the longer term impact is still yet to be felt. So if your client has significant exposure to the UK, even in terms of supply line, ultimate market, or use of the land bridge, then the mitigants and actions taken still need to be included in the funding proposal, as well as evidence that any customs implications and delays are understood. Just because a business hasn't been affected yet, it doesn't mean it's not going to be in the short term, and that needs to be considered. And then on slide 22 there's just a list of supports available in the bank that for anyone who might need it. There's our Brexit hub. We have 32 Brexit advisors. Our foreign exchange team is on hand. So all just good resources for anyone who may need it. So just moving on then to the next slide. Thank you. I just want to talk about the SBCI funding that's currently available through the banks. There's a lot of details in these next few slides. So I'm just going to do a high level overview on this slide. And then the following two slides provide greater detail, and they'll be a useful reference for people after this talk. And look, I'm very happy always to chat through the detail of this with anyone who might find it useful. So on the Brexit and COVID loan schemes, these are working capital support to businesses in order to address the impact of COVID or Brexit. At the moment, the loans are available until the 31st of March or until fully subscribed. So the key features of these ones: the loan amounts are from 25,000 up to 1.5 million per business, but that amount includes any previous SBCI, Brexit or COVID support. The loan terms from 1 to 3 years with an interest-only option at the start. The rate is 4% fixed. A business plan is required, but no security is required. And the loans can be used to fund working capital needs, to fund innovation, change or adaptation of the business to mitigate against the effects of COVID or Brexit. However, primary agriculture, fishery or aquaculture are not eligible. The second one there was the Future Growth Loan Scheme. This was very popular given the longer term of 7 to 10 years, but unfortunately it's fully subscribed and no longer available. And then we have the Credit Guarantee Scheme, which is a variable rate term loan for businesses who have been impacted by COVID-19. The scheme is available until the 30th of June on a first come, first served basis. So this is for working capital, including liquidity needs, or investment, or for refinancing COVID-19 related expenses that were initially funded through short-term facilities such as overdrafts. So it's potentially applicable to a lot of businesses. The scheme is aimed at businesses that have experienced an adverse impact of a minimum of 15% in actual or projected turnover or profit due to the impact of COVID. So then the key features of this one: facilities between 10,000 and 1 million. The term is from 1 to 5.5 years. No security required for loans up to 250,000. The interest rate is up to 2.75% variable, so that's very attractive. The applications are made directly to the banks. There's no eligibility code required in advance, as with some of the other schemes. and there is a fee payable to the department as a contribution to the cost of the scheme. So while refinancing COVID-related expenses such as overdrafts is allowed, the refinance of non-COVID related debt is not permitted. So it's important to bear that in mind in any application, as it has to be specifically linked to a COVID effect. So that's just a whistle-stop tour of the SBCI funds available. They're very popular, particularly the Future Growth Loan Scheme and the Credit Guarantee Scheme, and they're definitely worth looking at as part of any current funding application. The schemes are dealt with in more detail in those two slides then for anyone who would like to know more. Just before we move off SBCI, it's just worth reiterating a point that I made earlier. It can be very tempting sometimes to provide a warts and all or an overly pessimistic view of a business when seeking financial support. And I know it can be quite cathartic sometimes in uncertain times to get the worst case scenario down on paper. However, there really is no need to be overly pessimistic if it's not warranted, as this can make it really difficult to access funding at the moment. And for example, for those SBCI loans, you do need to prove that as at the 31st of the 12th 19, that the business was viable and not in financial difficulty, and that the business can return to viability in the short term. So just to bear that in mind. So just moving there to slide 27, Fiona, please. So due to the impact of COVID and the uncertainty surrounding lockdowns, many businesses might be reluctant to take on additional debt right now, or may struggle to show repayment capacity in the short term. So just to mention that there are some other alternative sources of financing and support that may be of benefit. In light of the dawn, I suppose, of negative interest rates and an increase in deposit balances held by some businesses at the moment, it may be more prudent for those businesses to use cash reserves now rather than hold them on deposit and take on additional debt. And we've recently seen an increase in businesses doing this. And also just to remind people about invoice discounting, which is another method which is very suitable for very useful for suitable businesses. It releases cash tied up in trade books. It can be done on a confidential basis. It's funding only. The bank doesn't get involved in collections. It can be a revolving or an interest only facility. And because it's a facility that grows with sales, it can be a very effective tool for funding working capital. Thirdly, on finance and leasing, look, we tend to think of F&L with regard to financing assets such as equipment, plant and machinery, which everyone is familiar with. But we also provide specialist finance and leasing products which enable businesses to spread the cost of large annual payments over a period of 11 months. For example, for spreading the cost of general insurance premium like public liability, medical insurance, professional insurance, and so on. We also have a prompt pay, which can be used for spreading the cost of all the large expenses like preliminary tax, pension contributions, audit fees, commercial property rates, and so on. So the point being here really that even if these items have traditionally been paid upfront from cash before, it may be worth this year considering spreading the cost just to improve cash flow. And then lastly, on the payment breaks or forbearance measures, in association with your lender, look, it might be appropriate to consider a forbearance measure such as a full capital and interest moratorium for a period of time to free up cash, particularly if the funding shortfall can be demonstrated to be short term. Unlike the payment breaks, which were a feature last year, there may be longer term implications of forbearance measures for a business. So it's important to discuss the suitability of those with your lender, though they can be very effective measures. So those are just some alternative ways of improving cash flow where a business may not want to take on additional debt or may struggle to show repayment capacity in the short term. So lastly, moving on to slide 28, and in conclusion, when looking to raise finance for your business, as well as all the usual considerations, it's really important to consider the particular challenges we're dealing with now. Consider the implications of the changed environment, settle on your assumptions using sector-specific details, deal with the impact of COVID and Brexit head-on, be balanced and realistic, and consider alternative sources of funding and support. And as always, early engagement with your lender will be key. Not only will doing this make any application for funding easier to assess for the bank and more likely to be successful, it will also provide you with a really useful and really robust assessment of the current and future outlook for the business and allow you to have a more informed view on the most appropriate form of financing. So thanks very much. My contact details are there on the next slide if anyone likes to chat afterwards, and I'll now hand you back to James.
Thanks very much, Susan. That was great. And now we're going to get the Enterprise Ireland view to finish. So Ciara Fitzpatrick is the manager of the Commercial Evaluation Department within the Investment Services Division of Enterprise Ireland. The CE department is responsible for conducting independent assessments of all funding proposals being considered by the funding committees within EI and supporting development advisors through the process. In 2020, Ciara managed the development and implementation of the large Sustaining Enterprise Fund to provide liquidity support to companies impacted by the COVID pandemic. Funding between 100,000 and 800,000 was made available to applicants as part of a tripartite agreement with the banks and the companies. So to talk further, we've got Ciara Fitzpatrick. Thanks, Ciara.
So good morning, everybody, and thanks very much for the opportunity to talk to you today about the funding supports provided by Enterprise Ireland to our client companies. As many of you will know, EI provides a very wide range of supports and uses a number of different funding instruments, some new instruments which were introduced last year in response to COVID. Today, I'm going to briefly look at 3 areas of funding which I think will be of most interest to you. And they are the supports introduced in response to COVID-19, funding for post-Brexit initiatives, and also funding for HPSUs. And then I'll very briefly look at the assessment process at the end. So just moving on to the next slide. Before I get into any of the detail, I just thought it would be useful to remind you of the criteria that qualifies a company as an EI client. So broadly speaking, we support Irish-owned manufacturing and internationally traded service companies. Where a company is foreign owned, the management must be based in Ireland and must have autonomous decision-making power. So an example of that would be, say, a food FDI company. So FDI, as in, foreign direct investment, and food is the only area of FDI which is managed by Enterprise Ireland. Obviously, all other FDI is managed by IDA. In order to qualify as an EI client, a company must be either a high potential startup or HPSU, and I'll come to these later on. And these are companies that have the potential to generate $1 million in revenue and 10 plus jobs within a 3-year time frame, or they're established companies employing more than 10 full-time staff. Any companies that are employing less than 10 staff are managed by the local enterprise offices. So the client base of EI is comprised of companies that are Irish-based and whose growth and development will be enhanced through working with Enterprise Ireland. So just moving on to the next slide. Thanks, Fiona. This is a busy slide, I appreciate, but really it's just to highlight the range of financial supports provided by EI. And as you can see, we support startups, we support small to medium enterprises or SMEs, and we support large companies. And we do that, we support them by helping them to explore new opportunities and grow their business, addressing competitiveness or developing new ideas. All of these supports are available to companies at all times. You know, obviously we have specific supports to address COVID, but all of the existing supports are also available. On the left of the screen here, excuse me, we also have some calls for proposals that happen throughout the year, and these are typically time limited and budget limited. So the first one there on the screen I see is the REDF, that's the Regional Enterprise Development Fund, and that is an initiative to support and improve enterprise capability in the regions. What I should say also is typically support for startups is by way of equity, and typically support for SMEs and large companies is by way of grant. And the quantum of grant depends on the size of the company and on the location of the business. So as we all know, and Susan and Fran have talked about the impact of COVID, it's created severe challenges for Irish businesses. There's been significant job losses and there's an uncertain road ahead for a lot of companies. But the theme of EI supports last year and now has been to stabilise, reset and recover. And we have introduced a number of initiatives to help businesses plan for the short and medium term. We rolled out liquidity supports for SMEs and large companies. And we also saw the rollout of the COVID-19 product scheme, which was to encourage innovation and combat the pandemic. So these are the range of supports. I'm not going to go into these in each of these in detail, but these are the type of supports that we introduced to support companies in addressing the liquidity issues that as a result of COVID.
The two that I'm going to focus on, which you're probably most familiar with, are the Business and Financial Planning Grant and the Sustaining Enterprise Fund, the large one in particular. On the first one, the Business and Financial Planning Grant, it was 100% funding of up to 5,000 for companies to access support of an approved financial consultant. And I think Susan mentioned earlier on that it's difficult for companies to prepare projections. And I think in EI, we're certainly aware that the financial capability in a lot of our client base is weak. So this support was really there to help companies put together and work with a consultant to put together a robust financial plan. And that plan could be used if the company was looking for support from the banks or from any other financial institution or from EI itself. We had a huge take up on this offer. There was over 1,000 approvals last year, and that offer is still open to companies to apply up until June of this year. The other one I mentioned there is the large Sustaining Enterprise Fund. And this was rolled out in April, or launched in April of last year. And it was to support companies with immediate liquidity issues, and also to help sustain their business in the short to medium term. Support of between 100 and 800,000 was made available to companies. And it was part of a tripartite arrangement between EI, the promoters, and the banks. So we would have worked, not just the banks, funding providers, I should say, but we would have worked closely with both AIB and Bank of Ireland with this particular support. There was new funding instruments introduced as part of this initiative. So we saw convertible loan notes, repayable advances, all new to Enterprise Ireland and new to the client base that we've dealt with. There's also been significant interest in the Sustaining Enterprise Fund. On the large fund alone, I think to date we've approved just over 400 approvals. This particular fund is not open to applications, to new applications at this point in time, as we have a significant pipeline that we're actually working through at the moment. In terms of, I'm just going to move on to the initiatives that we've introduced for post-Brexit. And I suppose, as has been mentioned earlier on, our trading relationship with the UK has changed, but the UK is still a very important market for Irish exporters. And it's now a third country with no customs requirements. So the following, I'm just going to briefly run through the range of financial and advisory supports that we have introduced to help businesses succeed in this environment. The first one here is the Ready for Customs grant. And this provides companies with financial assistance to cover the cost of taking on additional customs clearance staff. So there's grant supports of 9,000 available to support the recruitment or redeployment of a full-time employee into a dedicated customs role. Support for redeployed staff this is the only initiative that actually supports that, the redeployment of staff, and those staff then are typically backfilled. Support can be either for full or part-time staff, and the grant contributes to the recruitment costs, employee costs, and provision of IT infrastructure. This is a specific fund. There's an agreed amount of 20 million available to that fund, and it is due to close on the 31st of March, or if that fund is dispersed prior to that date, whichever is earlier. The type of enterprises that are accessing this kind of support are the freight, haulage, logistics service businesses, and anybody really who's dealing with or engaged in the movement of goods to, from, or through the UK. Some of you may be familiar with, or may have been familiar with, our Be Prepared grant that's now been renamed the Evolve Strategic Grant. And again, this offers support of €5,000 to companies. It can be used to cover consultancy or international travel when we're allowed to travel again. And it's associated with a short assignment to determine how a company might respond to the threats or opportunities that have arisen as a result of the changes to the trading environment in the UK. There's a very broad range of activities that can be supported. So, for example, a company may want to look at approaches to optimize its supply chains. It may look at scenario planning for markets over the next number of years, or researching market opportunities as the market evolves and changes. As I say, it's a very broad initiative that is available to companies. And the final initiative that I'm just going to talk about is it's the Post-Brexit advisory support. And this is to help businesses create a strong action plan and identify the risks and opportunities that the new trading environment obviously may pose for their business. It's available to Enterprise Ireland supported companies only, and it's delivered at no cost to the company. It's intended to help the companies strengthen their capabilities in two areas, strategic sourcing and customs and logistics. It's conducted there's 2 half-day sessions with an independent consultant, and as I say, it's delivered at no cost to the company. If a company is seeking support under financial and currency management, we would redirect them to the business and financial planning grant, which I've just mentioned earlier on. If anybody is interested in any of these supports, there is a Brexit unit within EI, and contact details are available at the end of that slide. I can, obviously these slides will be made available to everybody, and if anybody needs any further contact details on any of those initiatives, I'm more than happy to help. The third area that I just wanted to look at then is in the HPSUs, or high potential startups. And as I mentioned earlier, HPSUs are those businesses that have the potential to develop a product or service for sale on international markets, and that can create 10 jobs or 1 million in sales within a 3-year time frame. And funding is aligned to the company stage of development. So we really, when we're talking about HPSUs, we see 3 different stages of development. There's the feasibility stage, the investor ready stage, and the growth stage. Just move on to the next slide. Thanks. So at the feasibility stage, I suppose this is where companies at this very early stage can actually access grant support as opposed to equity. So companies or individuals can look at feasibility study, and this provides support of up to about €15,000 to look at the development of an investor-ready business plan. And there's various different costs that can be covered as part of that. Moving on then to the investor-ready stage, there's a number of different avenues that companies can explore. So the Competitive Start Fund there's a number of these calls for proposals throughout the year, and they can either be industry specific or they can be region specific. But what it provides the CSF is 50,000 equity to a company, and the matching funding is 5,000 from the promoters. There's been a huge take up in this over the last number of years. What it does is it gives somebody the opportunity just to prove the concept. EI takes an equity stake, obviously, in the business at that point of up to 10%. If the company is successful then and moves on and develops, they may then come into the full to seek full HPSU funding, and that is where we provide funding on a co-funded basis. Typically, our investments are of the order of about 250,000 that would be matched, as I say, by external funders. That might be a VC, it might be friends and family, it can be a range of different funding providers. And then post investment from HPSU, there is also access to other grant supports. The one I've just highlighted here is the Market Discovery Fund. And this is really about incentivizing companies to expand their market reach beyond Ireland and to look at new geographic markets. In 2020, and we just announced our HPSU class of 2020, we approved, we saw 125 companies, 45 being approved competitive start funding, and 80 innovative HPSUs last year. And we approved 48 million in funding for those companies. finally, then, I'm just going to have a very quick look at the assessment process. And this really is a whistle-stop tour. We accept online applications, and that's typically for grant-supported, for grants. They're submitted by the company through the EI portal, and they're assessed by the development advisor. And they're signed off at department or divisional level, depending on the value. And the turnaround times from submission can vary significantly depending on the offer and depending on the information that's provided at the time of application. Offline applications, which are typically supports in excess of 150,000, are submitted directly to the development advisor, and they're directed to the relevant funding committees. A detailed due diligence will be undertaken by the development advisor. They prepare a proposal for submission to the relevant funding committee, and then my team would provide an independent assessment of that proposal, really looking at the risks, ensuring that the business is viable, and outlining the key issues to the committee to enable them to make an informed decision. So I suppose our funding committees meet on a fortnightly basis. And again, I suppose the turnaround time for these larger applications can vary significantly. I know last year with the Sustaining Enterprise Fund, we were turning around applications from receipt of application to payment within 4 to 5 weeks. The larger supports like R&D, employment grants, they can take a bit longer. It really depends on, as I say, the information that we get up front and the due diligence, where the due diligence, I suppose, takes us. So that is, as I say, a real whistle-stop tour of the supports that are provided by Enterprise Ireland, or some of the supports. As I say, all of the existing grants and initiatives are still available to our client base. And if anybody has any queries on any of them, I'd be more than happy to take any questions now, or you will have my contact details, which is on the last slide. Thank you very much.
Thanks very much, Ciara, and thanks to all our speakers, Fran and Susan also. So we have just 3 quick questions actually that have come through here. So I might just start. First of all, open to whoever wants to take it. What supports are available to businesses on current loan repayments now that the payment breaks are over, but businesses are still not open?
Yeah, I might jump in there on that one, James. Look, I suppose, we've gone through this other supports there. Consider what you've done, consider what costs cutting can be made. The SBCI funding may be very suitable, and there are the alternative sources of a support there where a company may just not want to take on additional debt, but just may want to improve cash flow within the business.
Yeah, I might just add to that, Susan, and say that, the blanket payment breaks, I suppose, are no longer in play. But I think it's fair to say across the banks, we're taking a very case-by-case approach to companies. And we have a large cohort of customers who operate in, severely impacted sectors. So hospitality and travel and retail. So, for all of those, there are individual mechanisms available. So be it changes to your payment schedule or emergency kind of working capital type funding. So, I would say for anyone who is looking for the supports there, talk to your contact or hopefully your relationship manager in the bank, or talk to the bank about, your assessment of how you're going to manage those loan repayments, and talk to them about what might be available to alleviate or help, particularly over the coming months as we hopefully get through the last period of lockdown.
Thanks, Susan and Fran, for that. Next one, if a new customer is considering approaching the bank for funding for the first time, how should one go about this, given that site visits to customer sites are unlikely at present and getting to know each other is more challenging, etc.?
I think we've all adapted to the virtual world quite well, and I'm sure, Susan, you've equally seen that we've done a lot of transactions or finance transactions where they've been done completely virtually or remotely. So even one of the examples I referred to earlier was a new to bank customer, and that transaction was done during the course of last year, starting off in April 2020 and then closing during the summer. So that was done fully virtually in terms of meetings with clients, all interactions. There was no particular site visit in that individual case, but we have seen transactions where we've had done virtual site tours and used, you know, by email, photos and videos. So there's lots of ways, and we've certainly adapted to, I suppose, to how we all have to work now. So that certainly isn't, you know, wouldn't be an issue as such. There's ways we've been able to work around that.
Great, thanks for that. Thanks for that, Fran. And then the other question, I think, is more for Ciara. Are there specific EI supports available to support digital transformation projects in companies?
There are supports, but I suppose what we'd really like to know is just the detail of that. You know, we don't have a digital transformation offer per se, but we would have supports around that. So it could be included under R&D. It might be some other initiative, but definitely happy to take on that particular question and come back to it on an individual basis.
No, that's great. Just one final question for EI. Financial planning grant work highlighted that most firms react to financing needs rather than see financial planning as a strategic process. They'd benefit from 2 to 3 sessions per year to keep them on track at a strategic level. Would EI consider making grants available for such a purpose?
We would certainly have a look anyway. I mean, we're certainly aware that the financial planning within our client base and financial capability is weak. So we're looking at that all the time. In terms of the business of financial planning grant, we're conducting a review of that at this point in time to see, you know, what worked well, what didn't work, what needs to change. So I can feed that back into the review team and take that on board.
Great. Oh, thanks, Ciara. And just to reiterate that the recording will be shared later with the slides for everyone. So thanks very much. And just coming up now at 9:30. I'd like to thank very much Fran, Susan and Ciara for their time this morning. Thank Fiona Collins, as always, for coordinating the event on behalf of Chartered Accountants Ireland. And just very quickly talk about some upcoming events that we have with the Cork Society. Tomorrow we have a cook with Tricia Lewis just to walk through some recipes for us, so we can, I guess, have something to look forward to for the weekend. On the 5th of March for International Women's Day, there's going to be the first ever joint virtual International Women's Day conference with guests such as Sonia O'Sullivan and Niamh Briggs. Our topical practice day is on the 11th of March. There's a half-day session covering a number of topical issues for the practitioner, and there's a discount code of 25% until the 28th of February. So please keep an eye on your emails for that. And also further details will be launched on this today, but we're holding a rugby lunch to cover our normal Irish Cancer Society event this year. We're going to have a virtual rugby event with Mick O'Driscoll, Donal Lennon and John Kelly on the 12th of March, and further details should come through to your emails and online later today. But look, just want to close out now by thanking everyone this morning, and have a nice day.